Hi everyone, I'm Adam Thurgood, Managing Partner at Hightower Las Vegas, and welcome to our Summer of 2025 client briefing. We titled this presentation, Thinking Structurally and Cyclically, but before we get into the meat and bones of it, I want to do a little thought experiment. How many of you believe you were alive 1 million seconds ago? How about 1 billion seconds ago? What about 1 trillion seconds ago? Now, if you said you were alive 1 million seconds ago, congratulations, you were. It was 11 days ago. Now, 1 billion seconds ago takes us back to October of 1993, and unbelievably, 1 trillion seconds takes us back to nearly 30,000 BC. So I wanted that number to be front and center because it helps put into context how enormous our US government debt load is. We're sitting at between $36, $37 trillion in debt. We're adding over $2 trillion a year to this, and there doesn't appear to be any end in sight. And the issue is that the deficit has started to disconnect from the economy. Back in the 90s and the early 2000s, you can see that the deficit, which is the orange line, tracked the blue line, which is the unemployment rate, quite closely. And that makes sense because as unemployment goes down, there are more people with jobs paying taxes, tax receipts go up, and also the economy tends to be healthy with the low unemployment rate, so there's less need for fiscal stimulus, and vice versa. But what we've seen happen in the last 10 years or so is that linkage has started to break and is now looks to be fully broken. Today we're sitting at about a 4% unemployment rate, which should mean our deficit is basically non-existent, but it's now at 7%. And 7% is a number that we've rarely seen outside of really nasty recessions or major wars. Now, obviously, when you have a huge debt load and you have interest on that debt, you're going to have some strain just from the interest expense, and we're now running over $1 trillion a year in interest expense. But the big reason that this is occurring and this link has been broken is because of Social Security and Medicare. We have about $90 plus $95 trillion worth of unfunded liabilities that will move from being a future problem to a current problem over the next several decades. As baby boomers stop paying into the system and start drawing benefits, those problems go from being something we can worry about in the future to a problem that we need to worry about today. And it's putting upward pressure on our fiscal problems. Now, there are ways that we could get this down. For instance, you could means test Social Security, or maybe you could remove the income limit on FICA taxes, and those would help on the margin. But in reality, any changes to Social Security or Medicare have been proven to be highly politically unpopular, and neither party looks like they're, headed in the direction of making those changes and difficult choices. So what that leads us to believe is that the Fed will end up having to be the buyer of last resort, and that quantitative easing or the Fed buying of government bonds will likely come back in the future. And that's important because when the Fed does that, the money supply increases. And what we've seen over time is as the money supply increases, stocks tend to go up and gold tends to go up. So on a long-term structural basis, we believe that you have to have a bias to being bullish stocks and bullish gold and a bit more bearish on nominal bonds. Now, within a long-term structural trend, you can have cycles that cause you to deviate from these longer-term biases, and we're in one right now. We're a little concerned about the economy and potentially what that means for stock prices here in the shorter run. Our leading economic model, which looks at the economy through a variety of different leading economic indicators in 4 main categories: employment, production, consumption, and income, are all now negative. So it's looking like we may be headed for a weak patch in the economy. And what we've seen in the past is when all 4 of those are running negative, it increases the odds of a recession. Now, most of these are what are considered soft data, which would be based on sentiment or plans rather than hard economic decisions. And that means that they can change course before they actually impact the economy. And maybe sentiment will improve before we see hard economic data turn sour. But sentiment took a pretty big nosedive as a result of the tariff policy that was rolled out in early April. You can see in the top chart here, consumer sentiment plunged to very low levels, and CEO confidence, the second chart in blue, same kind of thing. They both rebounded a bit, but they're still at very depressed levels. And it's no wonder, because tariff uncertainty was quite high and actually still remains quite high. I mean, this just gives you kind of the path that tariff policy was on with the US and China in a 5 or 6 week period, which is absolutely bananas. And despite tariff rates coming down, not just for China, but for basically the rest of the world, we're still sitting at tariff rates that are as high as we've seen in 100 years. So this is a potential problem that we really don't know how it's going to play out. It's hard to say with any certainty how the elevated tariffs are going to impact business activity. Now, we've been in an income-driven boom for the last several years. You know, there were a lot of COVID payments directly to people to stimulate the economy, and that created a great environment for the consumer. So we think that the most important economic indicators to focus on now to really assess the health of the economy are labor indicators. And when we look at a long-term graph of the labor market, or the unemployment rate, which is here depicted in orange, it tells an interesting story, because it basically looks like a momentum index. It tends to go up for long periods of time and down for long periods of time. And what we've noticed through charts like this and some great research from some of our providers is that when the unemployment rate rises above the blue line, which is the 24-month moving average, it's been a pretty good predictor that a recession is near. Now, we've been above that level for several quarters now, and we're not yet seeing an accelerative move higher in the unemployment rate. Now, when people lose their jobs, they tend to file for unemployment benefits, and this can be tracked every week on Thursday through something called the initial claims data, and it shows how many people are filing for those unemployment benefits for the first time. We're seeing roughly 240 to 250,000 people file on a weekly basis, which is historically not that bad. We haven't seen this number spike up, and until that number spikes up, we won't be overly worried about the economy. It's hard to have a deep recession if you don't have people losing their jobs. But we are keeping a very close eye on this indicator in particular, because it is one of the most real-time indicators of what's happening in the labor market. Now, another issue that we see that is potentially concerning is that the Fed is really stuck. I know Trump wants the Fed to cut interest rates, but the Fed is worried about inflation, and our leading inflation model says they rightfully should be, because it's been ticking higher. Leading inflationary measures are going up, and that causes the Fed some angst with regard to cutting interest rates. So if they're on hold, it's going to create a more difficult environment for stocks. When it comes to stocks, we do believe the risks are elevated, specifically for the S&P 500. The S&P 500, the market's basically pricing in 6% earnings growth over the next 12 months with 13% earnings growth over the 12 months after that. That to us is signaling that the economy, or the stock market, is not worried at all about a weak economy or a recession. So clearly, if you had some economic weakness, that's going to make those numbers really difficult to achieve. But another concern for us is the level of profit margins and the expectation that margins will continue to expand. If you look at the top graphic there, you can see that the earnings growth rate is higher than the sales growth rate, which means margins are expected to increase. But margins are already at really high levels. In fact, they're in the 95th percentile historically. So we have a situation where the stock market is pricing in fairly robust growth with already high profit margins and an expectation that those margins expand. And when you couple that kind of riskier setup with the fact that valuations are elevated, we think that you have to be more concerned about, especially the S&P 500. It's trading at 22 times forward earnings. If you look at the chart on the left, you'll notice that that is way above the long-term average of about 16 times. And unfortunately, that has an impact on your projected future returns. You know, Warren Buffett is famous for saying that price is what you pay, but value is what you get. And unfortunately, when you pay 22 times forward earnings as your price, you tend not to get a lot of value over the subsequent 10 years. The chart on the right shows that the return of various valuation levels over the subsequent 10 years from its starting point. So today, at a 22 multiple, it's suggesting that the forward 10-year return on a per-year basis for the S&P 500 is basically zero. So that's concerning. And obviously, those risks that we highlighted with growth and margins expectations along with valuations make for us to want to be a little bit more underweight or focus on the true value in the market, which can be found in potentially other areas. For instance, if you look at the chart on the left, you can see that mid-cap stocks are priced essentially where their historical average has been, which is a much more attractive valuation. But we also think that there's better value abroad. This chart depicts the forward PE ratio going left to right with the dividend yield going up and down for various countries. And you can see the US is far out to the right and on the low side, which means that it's an expensive market that doesn't pay you a lot to wait it out, versus a country like Brazil that's very cheap and has a very high dividend yield, so you're getting paid to wait for that valuation to materialize. So whether it's Brazil or Korea or the UK or even Japan and a variety of other countries we didn't show here, there are better investment opportunities abroad. And what's interesting is our rotation model that looks at price trends between the S&P 500 and the international market has picked up on this, this trend change potentially. And it's looking like the market is starting to realize that there's better value abroad. And what this model does is it looks at price trends to determine which market's most likely to outperform going forward. And you can see over the past 15 years, it's been all light blue for the most part, meaning that the US was the place to be. But in the early 2000s or the 1980s, there were long stretches where international was the better place to invest. And this model flipped back to international about 4 weeks ago. So this is important because there are wildly different risk and return expectations when the model flips in one direction or the other. You can see that here. This is a risk-return graph, risk going left to right, return going up and down. And that light blue plus sign shows the S&P 500, when it's the preferred market, has about an 11% expected return, albeit with some higher risk, compared to the light blue minus sign, which is when it's not the preferred market. It still has about an 8% expected return and actually has a little bit less risk. But look at the difference between the plus and minus sign that are dark blue. When we have an international market that is non-preferred, it has a very low expected return of about 5% and a lot of risk. Compare that to where we are today, which is the dark blue plus sign, where we have an expected return above 12% with fairly low risk. So given that this trend model has flipped, along with all of the other fundamental reasons to think about why international stocks could be a better value, we think the two of those together are a pretty important signal change that we're going to keep a very, very close eye on and act upon as those trends become more apparent. Now, the fixed income market is also a bit tricky because the yield curve is flat as a pancake. Now, what do I mean by that? Well, you should be compensated more for buying a 10-year bond than you are for buying a 1-month bond. You're taking on a lot more uncertainty to buy a 10-year bond than you are to buy a 1-month bond. But today you're getting paid basically the same amount to buy a 1-month bond versus a 10-year bond. And that signifies that there's something wrong with the economy, something wrong with the rate structure. And it tends to want to push you towards owning shorter term bonds. Now, the problem is that if you're headed towards a recession, you would want longer term bonds because they typically would help hedge your portfolio more, but you're just not being paid to take that risk at this point. So we tend to favor shorter term bonds as a result. And another way to look at our portfolio diversifiers is through our currency and curve model, which our friends at Gavcol, through their research, helped us develop. And this model basically looks at 20 different countries to determine whether they are debasing their currencies, which is a fancy way of saying they're printing too much money, their money supply is growing too quickly, and whether their yield curves are sufficiently steep to entice investors to buy their long-term bonds. And the ideal place for bonds is when countries are protecting their currencies, when they're not allowing the money supply to grow too quickly, and they have sufficiently steep yield curves. That's the top left corner. We're nowhere near that today. We're close to the bottom right corner, which is the ideal environment for gold. Gold thrives when countries are debasing their currency, when they have no fiscal discipline, and when yield curves are flat. And today, 95% of the countries out there are debasing their currency in some form or fashion, and only 25% have sufficiently steep yield curves. So this leads us to want to be overweight gold versus bonds, and also to want to be overweight TIPS, which are Treasury inflation bonds, rather than regular nominal bonds. So when we put all the pieces of the puzzle together, we're left with 5 main takeaways that we want to stress today. And the first is that we remain focused on true diversification. If you own the S&P 500, even though there are 500 companies in it, you're not truly diversified. If you own the S&P and some bonds, you're not truly diversified. Those two asset classes are subject to various risks that can impact them negatively at the same time. We saw that in 2022. In order to have a smoother ride, you need more assets in the mix that have various types of exposures to different economic trends and activities to help mitigate your overall risk. And so we will remain committed to keeping our portfolios as truly diversified as we possibly can. We also want to carry a bit less risk given our concerns about the economy and those leading indicators pointing to a potential weakening or softening of the economy. We want to have inflation protection both on a cyclical and structural basis because governments appear to have no discipline anymore. So that means owning some TIPS in the bond portfolio and also owning energy stocks when it comes to your equity strategy. And of course, we want to maintain our exposure to gold because it looks like the most desirable hedge to a portfolio at this point and diversifier. And then finally, we want to be overweight international stocks because it looks like there are better values abroad. So that's all I have for you today. You know where to find us if you have any questions, and don't hesitate to reach out. Thanks for your time.